Welcome, everyone. It's Angelo Robles, host of the Angelo Robles podcast and the founder and CEO at Family Office Association. Really looking forward to today, a return visit by one of the most substantial and successful allocators at any level, family office, institutional. So it's investing insights from the CIO of the Sovereign Wealth Fund of the state of Alaska. Now, that's the title we're giving it. More formally, it's the Alaska Permanent Fund Corp. But in searching videos, how I described it is probably a little bit more germane to most people. Our featured guest is that CIO. That would be Marcus Frampton, CIO again of the Alaska Permanent Fund Corp. Marcus, welcome back to the show.
Thank you for having me, Angelo. It's great to be back on. I think the last time we talked was early in COVID, and I purposely did not go back and listen to that because I'm scared of the accuracy of my various thoughts. Although I don't think anyone could have forecasted exactly where markets have gone the last 6 months. So I guess can be forgiven.
Yeah, the markets have roared. The more money goes into the system, I guess the plunge protection team is not allowing the markets to drop. That's a little bit of my insider secret. My regulars kind of know what I'm talking about when I say that. We may get into a little bit of that with you, but again, I want to set the stage a little bit. I mean, Marcus is the CIO for an over 60 billion, that's 60 billion with the B, allocator on the institutional investing side. Now, we're more focused on ultra high net worth investors and family offices, but it's always great to hear what someone as intellectual and so active and prominent as Marcus, his opinions, and very much look forward to getting to it. And on that note, let's start very broad with the macro picture. I'm interested to know, who do you read, watch, and listen to from getting the big picture macro? Who are some of your favorites?
Well, we're fortunate at the fund here that we're allocating to some of the top macro hedge funds out there, and then also see, operating metrics and other information from our private market portfolio and whatnot. So I feel like we have a good seat here. The manager letters are always, really useful to me, but not available to the general public. More broadly, I read the Wall Street Journal. I'm sure most of your listeners do as well. And we subscribe to a research service, BCA Research. There's a few out there that give, weekly write-ups. I also read Grant's Interest Rate Observer and kind of an avid reader of that. So I try to get a range of, influences into my thinking.
Yeah, no, that's great. I think Jim Grant certainly does a great job. You mentioned, VCA and some others, and certainly I'm a fan of that as well. And I like to take in a lot of information from those and economists. I actually like to also listen, read, and watch people that I may not necessarily agree with, like my friend Peter Schiff on certain things, but it's always good to, listen to some counter arguments in a lot of different ways. So you can make the argument there's too much information coming in. You guys are active in a lot of funds. You're getting a gazillion, reports from the PM and their updates monthly and quarterly. And you're correct. You could get, you could drown and swim in those. And sometimes it's like too much coming at you. So knowing how to simplify the information and streamline it is very, very important as well. Now, you must have your own opinion when it comes to things like short, mid, and long term. So I'm going hardcore at you on whether deflation, inflation. Every economist I have on is something different. We're heading into deflation, but then inflation, then hyperinflation. It varies so much among them. Putting you in a position, how do you think that could play out during the time frames that I noted?
Yeah. So, one of your interviews I listened to this weekend before coming on here was your conversation with Rick Rule at Sprott. And I think he did a great job of caveating before every, statement he made. His background's a credit analyst, not an economist. And I think it's smart to frame where you're coming from. I think I'm in the same seat as many of your, family office allocators in that none of us are economists, yet we have a broad range of inputs from economists. And I think it's striking to me the lack of consensus among economists about inflation and what causes it. And, there'll be 5 to 10 year periods of time where macroeconomists gravitate around a certain idea, whether it's the Phillips curve or, in the 70s, Milton Friedman made the argument that the only thing that matters on inflation is money supply. That maybe was disproven in the last decade because we have had money supply growth, going back to the financial crisis. And then more recently, I hear about, expectations of consumers and employers are a big element to inflation. The only conclusion I can draw from that is that the experts don't actually know what drives inflation and the next cycle. And there are multiple types of inflation. There's Venezuela, Zimbabwe style, just money printing, debasing value. And then there's also a healthier inflation of just a recovering economy, consumption growing and slack being taken out of the supply chain. So I think that the tick up in inflation we've seen in the last 6 months is a reflection of probably a little of both, but more just the economy getting going again. People are driving again, consuming energy and whatnot. And over the next 5 or 10 years, the kind of like heavy money supply debasing fiat currencies could emerge. But I say could because I'm not an economist, but if you have central banks around the world responding to the market the way they have in the last decade and going forward, and there's not inflation, it just seems like all the economic textbooks are out the window. And so at a minimum, I think someone could say that the risk of a 1970s style decade ahead is more than trivial and more than priced into, inflation break-evens and things like that on the market.
Yeah, some really interesting comments. And true, the more that I've talked to many of the prominent economists and professors from that perspective, they're all wickedly intelligent, and I enjoy my conversations with them. And hopefully it makes for some good fodder relative to what I do. But yeah, they're so different. And at different points, if they go back far enough, they're going to be right. Not to say that a broken clock is right twice a day, but a broken clock is right twice a day. And a lot of them, especially the bear ones, eventually they're going to be right. But if you listen to what they said in the last year and were not active in equities and some of the crypto stuff, oh my God, did you get you missed out.
Right.
You really missed out. So there's no perfect answers to that, but I wanted to ask you that. I am going to have to ask you two of my Angelo slightly off the wall questions, but that will make it a little bit fun. Are the cycles of inflation and deflation actually needed to spur innovation?
To spur innovation, I think that a stable money supply is probably the right recipe for spurring a healthy, innovative environment. I don't think that heavy inflation or heavy deflation is helpful at all to innovation because, business people need to, plan out on 5, 10, 15-year horizons when they're making R&D investments and things like that. And, I don't think the monetary environment plays all that much of a role compared to other factors. But on the margin, having an unstable, dollar is not helpful for innovation, I would say.
And meant to be a little tongue-in-cheek, but only a little, why do we have taxes? Not something you have to worry about at a sovereign fund. The Fed can just print money. According to MMT, that kind of pays for everything. Why not just keep on printing more money? But in that case, why do we pay taxes? If you could keep a straight face, good luck on that one, Marcus.
Okay. Well, if I understand MMT correctly, it's saying that you can print money to fund deficits until inflation comes. So I think for, that brief period, maybe you don't need taxes, but, ultimately, I think we all know there's no free lunch. So, the tax will either be explicit or implicit in the form of inflation, I think.
And a little bit more classic and traditional. So let's talk a little bit about, in terms of some of the decisions of the Alaska Permanent Fund. I'm assuming it broadly starts with you and other thought leaders in the organization and out kind of developing and reevaluating, if not every year, maybe more than that, the investment policy statement, the parameters, the goals, et cetera. That then segues into an asset allocation strategy. And then lastly, although complex with such a gigantic organization investor like yours, the actual allocation and investment. So I look at that as being kind of a 1, 2, 3 process. Once you have the big macro picture, which we briefly discussed, and once you have internal discussion and debate, walk us through a little bit of what that IPS into asset allocation looks like inside the Alaska Permanent Fund and how those decisions are made.
So our investment policy contains our asset allocation, and the asset allocation is critical because it's kind of our North Star in how we want to position the portfolio. Our return objective is a real return of 5%, which, if you believe inflation's around 2, gets you in that 7% zone. And I would say 90% of institutional investors are explicitly targeting a return in that area, pension funds, sovereign wealth funds, et cetera, in that kind of 7 to 8% zone. And, so we do an annual exercise, and I think any investor should do an annual exercise on reaffirming their asset allocation or picking a new one, or at least studying it. And the observation I have is that, people have or institutions have generally maintained a return target like what I just said over the years. And to build a portfolio that they believe will deliver that, they've generally increased their equity risk and private equity risk, fairly consistently over the last 3 or 4 decades. So, this year was, I think, kind of a watershed moment for me on doing this exercise that I've done every year, in that our consultant, who gives us expected returns for each asset class that we feed into an optimizer, had the return on equities on a 10-year basis at below 7%. So implicitly, you could not, even with an all equity portfolio, say that you're achieving that type of return. So there's private equity, which is higher in their scoring. And so we're doing more private equity. Others are doing more private equity to hit these numbers. My observation is that, these portfolios that institutions and maybe many family offices are putting together work well in a growthy environment. But, if you look at the last 5 decades, a heavy equity portfolio didn't necessarily provide a good real return in the 70s, when we had inflation. And then the decade ending 2009, when we had 2 major bear markets in the stock market and 2 recessions in the decade, the real return on a equity heavy portfolio was negative as well. So you've got 2 out of the last 5 decades that the typical institutional investor portfolio doesn't achieve its goals in. And so I've been trying to emphasize assets that do well in those environments, both very low growth, low return environment, and then a high inflation environment. I think those are the 2 Achilles heels of most investment portfolios today, or how do you perform in those environments that can last 10, 15 years?
Yeah, really good point. So one of the questions I've been asking some of the economists, and it's a little bit of a tricky one, relative to priced in gold, and then maybe priced in oil, priced in timber. How has the S&P done? And like you said, there are various periods where basically it might have disappointed relative to how I described it, more than the typical person would think. And this is interesting in terms of a discussion. I'll make a comment. My audience probably feels it coming, and I know it's completely different from the institutional world. My opinion about inflation is very different. It's very aligned with Michael Saylor of MicroStrategy. For the super rich that, again, buy homes, London, New York, Hamptons, Malibu, want NFTs, want more crypto, want to buy more stocks when the market's going up, owning football teams, etc. Their inflation, pardon my English, it ain't no 2 or 3%. My God, I could argue for the last 12 months, maybe closer to 20, 30%. But again, that creates dynamics about how aggressive to be in investing, how important is purchasing power over time. Are you willing to sacrifice 1 or 2 years of potential growth for mitigating downside risk, looking more out in decades, not just in the last year? There's lots of different things to look at. And families that are taxable and different in their perspective are going to be very different from the institutional side. You generally have been an advocate of, and if I'm wrong, just stop me and correct me, of value investing. Uh, has value investing, it's easy for me to say this for the last 12 months, but I'm going to still say it. Has it been disrupted?
I I don't think it has. I mean, there have been these cycles of underperformance of value, and I think the last decade is probably one of the longer ones we've had. I mean, basically what we're talking about right now is what is the forward return on different parts of the market. And people can come up with opinions and theories, but the best predictor of the 10-year forward return on a market segment is its current valuation. And so we can break the market, we can look at the market overall, which would be the Shiller PE, which, that number is only been exceeded in 1929 and in the dot-com bubble. But then you can also break it into segments of the market. And so if you look at the current valuations on value stocks relative to historical, the forward return on them is, more in line with what someone would want from equity risk than the growth part of the market. So I don't think it's broken. I don't think anything fundamentally has changed. It's just where we are in the valuation cycles.
What will happen to value stocks if interest rates don't rise for the next decade, basically staying under 2%?
Well, I mean, I think any investor has to think about what's priced into the market. So if you're looking at financials, they've been under pressure for a decade because of the interest rate environment and the lack of a real yield curve. But that's fully priced in. Like you can build a very nice portfolio of regional bank stocks at a discount to book value and single digit PE multiples. So I think that whether you're looking at what the market's pricing in for the risk of very high inflation, or where the market's pricing stocks that rely on different interest rate environments, it's just very undemanding valuations to be coming in at. The market, inflation protected assets, probably the best way to judge how the market's pricing is to look at the break evens between tips and 10 years. And it's, in the 2% zone. So the market's not demanding a big premium for, stocks that have great inflation characteristics or just explicit inflation protection in the bond market.
Yeah, those are good points. I mean, I look at it and maybe I simplify it too much. And I know I'm different being an individual, but I want to own a stock. Wow, what a shock. That's actually going to go up. And
Right.
to title it growth and value, and then to look at something like some of the FANGs, and specifically adding on Microsoft and specifically Tesla, the traditional way of looking at it, again, if I would have listened to all these bears in the last year or two, wow, I would have missed out on some great, great gains. There's companies that are very unique, driven by unique personalities, in this case, Musk, and are doing things that are really futuristic looking. And you got to dig a little deeper, because how you traditionally value them, using that word value, I think is very different. Now, admittingly, I skew a little bit to growth and swinging to the fences. So I am going to have likely that more volatility, but I'm also looking years out. It's really complex in terms of what you do. It's just so big at above whatever 60 billion, and being the Alaska Permanent Fund and filing, what are they, 13Fs, it's public. So looking back the prior quarter, people could get a view. But I believe you're incredibly diversified. I believe potentially, let me know if I'm wrong, perhaps 100 or more ETFs and a significant number of funds. And part of that has to do with the size that you guys are, and not looking to take up any too big of an allocation relative to one. But if you could talk about that from the institutional perspective, and why it's important maybe to dampen volatility and dampen risk.
Yeah, I mean, the fund by mandate needs to be very diversified. And I think on the equity side, we benchmarked our equity portfolio against the MSCI All Country World Index. So that's about as global of an index as is out there. Within that, and we talked about our investment policy earlier, we get assigned by our board a tracking error limit. And so for equities, it's 4%. And then we think about how we're going to apply that sort of tracking error budget. So it's sort of the statistical variance between the expected performance of our portfolio and the benchmark. And, so I think that most individuals, if they calculated a tracking error in their personal portfolio, it would be significantly higher than 4%. And
Right.
what we end up doing is expressing most of our views through market factors and country over or underweights, and less so on individual stocks. So we, in the last year, we've had almost all of our tracking error budget devoted towards an overweight to China and then an overweight to value stocks.
Yes.
And the way we express that tends to be more through broad market factor portfolios than individual security selection. And I think it has to do with the size of our fund. I mean, and our resources. Like we have 3 people in public equities, so we're not, doing valuation analysis of Tesla, but we're observing where those types of stocks are versus other types of stocks and trying to emphasize where we see value.
And I mean, it's a respectful question. Hopefully others from the board or committees are not listening in, but is there something inside you as an investor that would like to be, to some degree, more concentrated, to take bigger bets on something that has more swing for the fences? Because that's going to be impossible to do when you have hundreds and hundreds of different funds and holdings, although admittingly, it can help to dampen volatility. So that's going to be what's going to make people from the Alaska Permanent Fund feel comfortable. But in your own investment portfolio and other things, you don't have hundreds of holdings, I wouldn't think.
Yeah, I mean, we have the ability to make some fairly big bets, and generally we just need to run it by our board. If we invest more than 1% of the fund in an opportunity, we preview it with the board and get their approval. To date, these types of opportunities have taken place in the private market side. So we had, going back to 2011, 2012, when I first came, we made a very large investment in a company called American Homes for Rent. So it was one of the first single family rental homes. But we came in, when it was private, and then it went public. And similarly, we've done that in the life sciences area. It's just, and so I think we've just had a little bit more appetite in private equity to take an individual company bet with some size, and that has to do with the size of our fund. I think if we were a smaller fund, we might find like interesting things to do in small caps and get involved with the company in size, but it doesn't really move the needle for us.
Right.
And then the large cap market is so much more efficient that we just devote our resources to kind of the private market, individual company deals.
Is there a belief yourself, those internal consultants, macro thinkers, all the access that you have, that having a significant number of holdings does help to decrease volatility and dampen risk? Or after a certain point, is that, what's the word, overrated and just adds to the complexity, holdings, and reporting that needs to be done?
Yeah, I think that the academic research out there suggests that you can have, like, the benefits of diversification are exhausted after, a relatively small number of holdings. It's not, we probably have 10 or 15,000 stocks in our portfolio. Is probably, we over diversified from that standpoint. Our public equity portfolio is almost all active external equity managers. We're an outlier on that. We don't own very much passive at all. So we have about 50 public equity managers doing different mandates, a couple China-focused managers, quite a few value managers, and some quant managers, some fundamental managers. And so we kind of look at our bets on the public equity side as our manager selection. And you could argue 50 managers is maybe too many, but each has their own kind of alpha return stream. And so, whereas if you have one stock picker, certainly that person shouldn't have the number of stocks we own. But we think of the bets we've made as kind of 50 manager selections.
And would you know the kind of technology and software you guys use that could share with family offices or ultra high net worth investors? When you have diversity in funds and holdings like that, there may be crossover that could kind of x-ray and see through and give you information to make decisions.
Yeah, I mean, we do benefit from pretty good portfolio management, risk management software. And so, we have a portfolio, it's about 15% of our public equity portfolio we call tactical tilts. And we use that, in that portfolio, we trade ETFs to kind of, to make market calls that we want to make, overweighting countries or factors, but then also, offsetting unintended kind of concentrations in the portfolio. But when we see episodes like GameStop in the news, like the first thing I do is pull up the portfolio and see what portfolios we own a stock like that in, and how it aggregates. And then, it's a high bar to intervene in some way, but we might offset it elsewhere in a portfolio.
So you do have the ability in most cases, especially given your size, scale, and brand, even with very private funds, to kind of know the holdings and kind of mitigate and manage risk, I guess you could say.
That's right, yeah.
Are you allowed in the Alaska Permanent Fund to short specific stocks or ETFs, or you rely on managers for that?
We don't. So in our public equity portfolio, all the positions are custodied in our name and we report them out on 13Fs, but our external managers are able to trade our account that's custodied in our name. We don't short there or elsewhere as the permanent fund, but we do allocate as a limited partner to hedge funds that short stocks. So in January and February, I was talking to those managers quite a bit to understand their exposures, but our exposure was limited by virtue of the fact that we're a limited partner in those funds.
And I mean, share with us a little bit, because even most family offices may not have that level of access, but you're a $60 billion plus allocator in theory. And I'm not saying you would get them that moment, but you could probably pick up the phone and schedule something with like a Howard Marks if you really wanted to, being respectful of his time. Maybe it's just 10, 15 minutes. What were some of the insights that you gleaned from some of the strategic hedge funds and thinkers going back earlier this year relative to the markets continuing but hedging risk? And was there anything that stands out to you?
Well, I think that, following the macroeconomic stuff, it reinforced the belief I already had that there's so many different opinions out there. I mean, I could have, and Howard, and by the way, on things to read, Howard Marks does put out a good letter that I think is generally available on their website on Oaktree. But I had, and then the other thing that really struck me was the performance of funds didn't really reflect the accuracy of the forecasts in their letters and whatnot. So you have funds where the CIO is writing extensively about their observations on the market, but in reality their fund is trading relative value individual trades that may not, if you just listen to the founder, you would think they have the whole fund in gold or something like that, and in reality they're doing a lot of different things. I think Bill Ackman got the most criticism for that because he was famously on CNBC, and we're not an investor in Pershing Square, but I have a lot of respect for them. But he was on CNBC in the depths of March, like bemoaning what was happening to our country with a very negative outlook. But Pershing Square was putting money to work in hotels and things like that at the time. So I think that's an example of like what the charismatic founder is saying or writing doesn't always necessarily reflect how the fund's doing or what they're investing in.
And in terms of you and your team, talk a little bit about that process of doing diligence on the manager and then updating it, whether with committee or others every year. It doesn't always stay static. You're going to get in and out of some managers. What are some of the thought processes you go through with that?
Yeah, I mean, we're trying to establish that the manager's process, that what attracted us to them about their process or their resources or how they approach the markets have been consistent. So we get very concerned when there's team turnover. We, I think, are fairly patient with periods of underperformance, but they kind of need to be consistent with what we understand the strategy to be. So March was a good test for our hedge fund portfolio because that's a portfolio that's supposed to be defensive and protect capital. And some funds did and some didn't. And some, had difficult months for reasons that didn't make sense to us. And so they're more under scrutiny than others. But there's no perfect playbook for it. But, it is important to keep an eye on the managers and make sure that the reasons you hired them still remain.
For sure. And will you be, I think when I looked at the 13F, you had a pretty good size allocation, I don't know, 4 or 5% scattered about in what I would say are gold or gold miners. Do you think you'll be likely staying stable with that, increasing, decreasing?
Yeah, I mean, gold has been a theme for us for 12 to 18 months, and it probably ties into the Bitcoin question in a minute, or whenever that comes up. In that, we've owned the gold miners on and off in that tactical tilts portfolio that I described, where we're trading the junior gold miners and the primary gold miners ETF. There were periods of time where that position was as big as 600 or 700 million for us. Over the summer, we reduced it a little bit, and now with weakness in the sector and in gold price, we've been adding to it, and I think we'll add more to it. We also own IAU, the ETF. The gold miners we're able to own because they're equities. The commodity ETF, we had to get board approval, and it was one of the most painful things for me because we first proposed it in late 2019 and it got approved in the fall of 2020. So was kind of like a series of meetings where half the trustees thought it was the worst idea they'd ever heard and half loved it. And meanwhile, with each subsequent meeting, the price is up like 20 or 30%. So we definitely have exposure to gold and the gold miners and are pretty positive on both going forward.
And staying a little bit on that theme, and I've been talking a lot with my audience, and it may be such a small market for you guys, but you may have some exposure. How about rare earths and uranium?
I have to plead the fifth on topics that I don't, I don't know enough about rare earth to have a view. You asked the same question to Rick Rule, which I listened to over the weekend. I liked his answer on the uranium side, and I would be completely plagiarizing him if I repeated it. But I think what he's highlighting is for certain commodities, and uranium may be one of them, we have a limited supply, and then we're going in this reopening, and just the realities of supply and demand have to play out. And I think that probably for uranium has a pretty positive outlook, if I understand it correctly. But I think there are a number of commodities in that category. I think commodities in general are underowned and have upside, for allocators of all sorts.
You do have experience, which I find intriguing, and some definitely good successes. What I'm going to say are buying companies, or maybe even through managers as well, but buying companies kind of coming out of bankruptcy. What do you look at in terms of, and maybe that could fit the value perspective of you're getting it at a good price and there's tremendous potential moving forward, but talk to us a little bit about that.
Yeah, well, I think that, there could be a great opportunity in distressed debt and bankrupt investing in the future. I mean, if you look at the last year, it was really kind of just the energy sector that there was oil and gas, that there was a lot of bankruptcy activity. but they create a lot of opportunities just in that these companies come out of the process clean. For the permanent fund, we play it through distressed debt managers, and then on the equity side when they come out. But in a way, and this is more drifting into smaller stuff and personal investing, but the when stocks come out post bankruptcy, so the debt holders get the equity and the equity then starts trading. It's similar to spin-offs in that there wasn't an IPO and there was not a book built of buyers, so you get a really unstable trading market in the month after bankruptcies come out, to the point where I did some research on this, that if you just trade post reorg equities the day they start trading and you hold it for 30 days, there's something like a 8 to 10% excess return in that period. So there's a good strategy, I think, of just looking at post reorg equities as a good hunting ground for value stocks with maybe irrational selling pressure because it's bondholders that don't want to own the equity as it comes out. So it's a good area to look, and then also it's a good area just to get exposure to everything that's coming out, because there's just unnatural selling at the beginning.
I think in general, in looking at your 13F, I would say you're relatively, and I'm being very broad, but relatively bullish on Europe. Why?
Well, from a valuation standpoint, I mean, it just, Europe has just completely lagged the US over the last decade, and then even more so over the last year with the relative performance on COVID. I think that our view is that Europe, in spite of the dysfunction, is likely to have, for the most part, broad vaccine availability in July, August, and markets being forward-looking, or as we move closer and closer to that, are probably going to, start treating Europe better than they have the last year. I mean, but it's individual countries and individual stories, and some will come out of the COVID experience better than others, I think.
And let's talk, and I believe you're accessing it mainly through talented managers, but in Asia. So generally, what are you guys doing? Staying stable, increasing, or decreasing, Japan specifically?
Well, we own Japan through sovereign bonds and then also through the equities. And it's, sometimes you read in the paper, who are these people that own negative yielding European or, Japanese sovereign bonds? And we own it, and we hedge the currency, and we find that we can get a positive return with some diversification doing that. But we don't have, we own less Japanese sovereign bonds than the benchmark we judge that portfolio against. And then same on equities. I mean, the only EM or Asian country that we're really overweight right now is China in our equity portfolio. And it's a modest overweight, so most of what we're doing, we're anchoring to the country weights in the MSCI All Country World Index. And then in the case of China, we've got 3 or 4 managers that we think have a pretty strong edge in stock selection there. And then just on growth outlook and other things, it seems like among the best of the EM. So we've got a couple percent overweight. And I say a couple percent overweight, but it translates into over $1 billion overweight. So
at the level that you guys are.
Small numbers.
Yeah. I mean, that was kind of going to be my next question. Southeast Asia exposure, ex-China, and then you already kind of hinted at China, your quote unquote relative to normal indices you would use, somewhat overweight. But broadly, ex-China for Southeast Asia, do you look at that as being there's just more growth opportunities?
Yeah, I think that's right. For the most part, our preference is to play it through private equity versus public equity. Tends to just be our benchmark weight. We're doing more. It's hard to get data on it's easy to get data on the percent of the public equity universe that's Southeast Asia. It's a little bit harder on private equity. But yes, by almost any measure, I think we're doing more in Asia than our peers. So that's been an emphasis for us as well.
And a little bit of the risk, the unknown unknowns. We would have thought COVID was one, but the plunge protection team, the IMF, whatever, a combination of many, and stimulus kind of kept that afloat. Uh, Debatable, probably a good decision, but we could save that discussion for more of an economic one. What I'm getting to, though, is for a fund of your size, when even with diversification, things could go really, really wrong, and that would not be good. Do you put some allocation towards tail risk hedge funds?
We've looked at that over the years and never concluded that we should do it. If you own tail risk in the simplest form, you're purchasing broad market puts, below the market price. And like many forms of insurance over many years, that it's a negative expected return. So the last time that we've talked about this with our board, I sort of took the argument that if we're playing in tail risk protection, we probably would be a good candidate to sell tail risk protection because we have such a long time horizon. We have no leverage on the fund. In contrast to pension funds that have pension liabilities that typically exceed the assets, we have no explicit liabilities. We're, the size we are. So there's probably no one in the world better positioned to sell tail risk protection than we are. So if we're buying it, we're almost by definition buying it from someone who's less creditworthy. Even if it's a Morgan Stanley, they had their moments of scariness in the financial crisis. So even if you're buying tail risk protection from Morgan Stanley, like in that moment where it's really valuable, the credit risk of the counterparty, may be worse than the market decline. So
when
we've never gone there.
Yeah, maybe.
Right.
Are you invested in farmland?
We have a little farmland investment. Yes. I think our total exposure through a fund, it's something in the neighborhood of 200 or 300 million. We have a manager that's taking kind of an operational approach to it. With some different, rotating in different crops and things like that. I think it's an area worth spending more time on that we may look at.
I agree.
Here. Yeah.
How about timberland?
Sadly, we do have a timberland investment, and it pains me every time I read the Wall Street Journal and I see articles about lumber prices and housing starts that, the owners of the timberlands haven't really been participating in that. And I think the sawmills have been the place to be because they're buying timber at the same price or buying logs at the same price they always did, and then minting a fortune on cutting it into lumber.
We have a question that came in from a live participant. How are you approaching ESG and impact investing? Do you have even a specific mandate?
Well, we don't have a mandate at this point, and I think it's definitely been the topic of the day or the last few years. So we've been starting to think about it a lot. It's a tough one for me to tackle because it's so broad and it means so many different things. But our mandate remains simply to make good risk-adjusted returns for our stakeholders. Like if you look at our infrastructure portfolio, which is, a several billion-dollar portfolio, in the last 8 years, we've gone from no renewables to it's now like 40% of the portfolio. So yeah. I think we're trying to direct our capital to where the puck's going, and that's meant less oil and gas infrastructure and more renewables. But it's definitely on our agenda to kind of formalize things a little bit more, or at least to study the topic and think through what we're seeing others do that make a lot of sense versus what others are doing that might be more marketing or other things. But we're not, and we from time to time get the fossil fuel divestment argument, which I kind of find somewhat ironic that the source of funds of our fund is, fossil fuel royalties. But, and I think the oil and gas industry demand is still growing and will for some time. So we're probably not ready to divest fossil fuels, but we do get, some pressure on that front from some stakeholders.
And other than the more niche of farmland and timberland, broadly in real estate, obviously uniquely impacted during COVID. Perhaps from a long-term perspective, depending on pricing of some of the funds you're getting in terms of what they're buying, it may be a good play. But you have to look at office space, hotel. A lot of the traditional real estate has been rocked. And again, maybe long-term, depending on the pricing they could buy it at. How are you monitoring the managers where you're getting that exposure? And do you have any direct investments in real estate?
Yeah. Yeah. Real estate's the one area that we've done mostly direct in that we hold property in our name. We're generally trying to buy Class A, high quality assets. And we're in this, and we're trying to grow that portfolio. So we're in this environment where certain areas that you mentioned have gotten hit hard. And then the stuff that investors like myself and our fund want to get access to, so multifamily and industrial, haven't been hit that hard. So we've looked at quite a few acquisition opportunities in those, and it feels very expensive. And just by way of anecdote, just in the last month, we bid on a large Class A apartment complex at a sub 4 cap rate, and didn't move to the next round in the process. So like there's just some real strong bids out there for the high quality real estate. But I'm looking at it as something we need to own, because there is a reasonable chance that we enter a 1970s style inflation episode, and I think apartments will be good assets there to complement gold and other things.
And what is your current allocation to bonds?
We have a 20% allocation to bonds, and it's mostly investment grade corporates. We also, like I mentioned earlier, own global sovereign bonds. I think that fixed income has come under some scrutiny on why are people owning, assets with such a low expected return. I kind of flip it. I look at where the Schiller PE is today, and I think maybe the 10-year real return on stocks might be low single digits. So I'm not sure that, every time someone asks me, why do you own 20% of the fund in fixed income? My response is kind of like, you should be a little bit more worried about the 40% of the fund in stocks, given the higher volatility of stocks and given the valuations where they are today.
Do you see a question from a listener? Do you see current investment opportunities in distressed opportunities in energy?
Yes. So our distressed debt managers are active in energy. I mean, a lot of that has played through, though. I mean, there was a significant amount of oil and gas bankruptcies over the summer. And so to some extent, it's played out. I think oil and gas and energy have, whether it's distressed or whether it's just CapEx on new wells, they have a higher return profile than most corporate CapEx opportunities today. So, we're talking about renewables. Renewables have a great profile because you're locking in 20 years of cash flows at, with high quality counterparties for most parts, but they're low return opportunities. They're probably mid-single digits. Whereas, my understanding is that private equity firms or small oil and gas companies are, investing in wells at, mid-teens unlevered returns with reasonable commodity price outlooks. And so you might be looking at a 3 or 4 year payback instead of a 15-year payback, for renewables. So I think there can be a role for both in a portfolio.
Which investment consultants do you work with, and kind of in what capacities, and asset and liability study alternatives? That's a pretty broad question, but we'd love to hear a little bit of your feedback.
Oh, sure. So a firm called Callan Associates is our general fund consultant, and they work with us on our asset allocation. They do our performance reporting, and they actually report to our board. So they're our board's overall consultant on the fund. Then for each asset class, we have a different consultant that we work with to identify and diligence individual opportunities. So Alborn on hedge funds, a firm called RCL Co on real estate, and then a few different ones on alternatives, a firm called Pathway Capital and Mercer. So we've got no shortage of consultants floating around at the fund.
Have you seen any demographic shifts in Alaska because of the pandemic? And if so, has it affected your investment strategy?
Well, I'll give a plug for traveling to Alaska. I mean, right now in Juneau, it's amazing. It's sunny. It's, in the mid 60s. And normally this time of the year, there'd be 3 or 4 enormous cruise ships docked. So Juneau is a city of 30,000 people. It's a pretty small capital. And we get in a normal year over 1 million people coming through
Wow.
Juneau on cruise ships. And it's, as you would expect, a big driver of the economy in the Southeast Alaska. So, I don't think you can't come on a cruise ship because they can't stop in the Canadian port on the way, which is a requirement due to COVID. But there's never been a better time to see Alaska by hopping on a plane because it's amazing. And normally it'd be flooded with tourists and there's no one here. So that's the good news. And I'm enjoying myself around town. The bad news has been for our economy. I think that, mostly the state's driven by oil and gas or related activities, but tourism would be the second, and commercial fishing and mining after that. So some are doing better than others, but generally speaking, I think the state has been, in terms of unemployment and things like that, one of the harder hit in the last couple of years. And we do invest in the state. We have a private equity program that targets opportunities in the state, and we've found things to do. There was made a fairly large investment in a commercial fishing company in the last year. Looked at some kind of distressed tourism stuff, and then on the public side, there's 2 publicly traded banks and 1 utility. So you can there's 3 stocks to pick from, but I think the outlook is good because the state has the permanent fund, which is just like relative to the population here and relative to the size of the state's obligations and budget, like they're very well funded, but the economy here isn't that diversified, and it's been a tough couple of years.
Is there any investing allocation to cannabis or hemp?
No, not that I'm aware of. I mean, it's possible that somewhere in our venture portfolio, someone's backed a cannabis company, but not to my knowledge.
Okay, now, Marcus, it's the fun time. Roll up the sleeves. You're going to get to Angelo's crazy stuff.
Okay.
A little bit of a taste of it much earlier, but here we go. I'm assuming, and I know I'm going to mess up the single family office name. Don't hate me too much on YouTube. Okay. But Bill Huang and Archegos, I'm assuming you are familiar with it.
Oh, for sure. Yeah.
Okay, so to give our audience a pinch of context in case they're not, and I get in trouble when I talk about it because I talk about it like, wow, the guy's amazing. There are aspects of what he does are absolutely amazing. To come from nothing to work in the industry under Julian Robinson, and Julian loved this guy, and to build up a net worth of 200 million. I mean, come on, that's amazing. Yeah. And kudos to his amazing success in finance. But then to take 200 million and in 7 to 8 years, arguably convert that up to 30 billion effectively liquid. I mean, wow, that's more than the net worth of a Steve Cohen, of a Ray Dalio. That's 150x return. That's an all-time great. Is this guy, including the missteps with risk management, the modern day Jesse Livermore?
He could be. I think, yeah, I mean, I've read the different Jesse Livermore books. I think that's probably about as good of an analogy as you could come up with.
I think
it's just amazing to. It's always hard for me to put myself in the risk framework position of someone like that, or someone like, Elon Musk, who was a billionaire from PayPal and then rolled it all into Tesla and SpaceX. I mean, that is just a different orientation towards risk that, I mean, I think Jesse Livermore is a good comparison to Bill Hwang.
Yeah, for those that don't know, this goes back what Livermore around like 1900 had a
Yeah.
net worth of about 100 million back then in those dollars, but went bankrupt 3 times and unfortunately didn't end good. If I remember correctly, he committed suicide. These kind of people that are incredibly Machiavellian, big you know what, and just really, I mean, there is like a I don't know what the word is, just something to learn from them, unfortunately, on both sides, including mitigating and managing risk. But we don't have the full picture. What was personally guaranteed? What other assets? I mean, he still may be a billionaire. I don't know. And this is the kind of guy, even if he's not, he's been a very successful investor for a long, long time. And actually, now I am going to segue into a question from that's going to be very applicable for you. We see many hedge fund managers like him, and many much more well known, that say, enough, I'm already rich. And they're going to say, the pensions and big institutional investors don't want me to be swinging for the fences. They don't want the volatility. And I'm bored getting 6 to 8%. I'm going to close down my fund, become my own single family office, do what the hell I want to do. And a lot of them are believed to be getting 30, 40% returns. I mean, Wong was special at 150x over 7 or 8 years. That's a different category. But do giant institutions kind of demand dampening volatility and taking away hitting the grand slams?
I think you're probably right. They do. I mean, I think the hedge fund industry as a whole probably runs at a volatility level of mid-single digits and an expected return of mid-single digits at best. And a lot of it is the allocators. I mean, I try to,
You're
some
honest,
of our
Marcus.
hedge funds have different volatility targets, and I always try to target, it's not uncommon for, a systematic macro manager for their flagship to be a 12 vol, but also offer an 18 vol. And I generally try to pick the 18 vol because, when you add up 20 hedge fund managers that all target 12 vol, the combined portfolio vol is half of that. And if one or two of them have a bad year and the winners are making 6 or 7%, like the portfolio taken all together isn't all that interesting. So I try to gravitate towards higher volatility hedge fund managers, but the industry has not done that. And I think your observation is absolutely correct. A lot of these guys or gals can achieve much more interesting returns when they're not shackled by, a bunch of clients that can't tolerate a 5% drawdown.
Wow. Yeah, no, that's great feedback. Okay, I asked you this question last year. You were intrigued by it. It was too early. You were going to do research on it. Lots have changed besides Paul Tudor Jones's paper that you referenced last year. The drum roll, Marcus, then we'll do the deeper dive.
Yeah.
Has the Alaska Permanent Fund invested in Bitcoin?
Not explicitly in our name. So, and, it's something that may be on the agenda in the future. I described it took about a year to get gold in the lineup, so an asset that's been a clear store of value for thousands of years was a controversial ad. But so in that lens, Bitcoin is like the next level of the video game to figure out how to get that through the process. But I'm cognizant of the limited history versus gold. But when you're talking, I think Paul Tudor Jones and others have talked about 1%, 2% of portfolios. And when you're at that level, you're kind of think about it as like an option on an unknown future. It's not a core holding, like it's not 10, 20% of a portfolio. So I think it has some merit. I'm certain that certain of our hedge funds trade it. So managers like trend following CTAs, it's not uncommon now for them to be trading Bitcoin with the same trading signals that they would use on wheat or
right. So you might have some indirect exposure.
So I'm sure we have that in there, and some of our venture managers are active investing in the space in different ways. So there's some exposure, but it may be on the agenda in the next year to look at doing something with Bitcoin, but it's a high bar to get a new asset in. And I think it's appropriate.
Does it help a little bit when you talk to some of your peers? We all know that Mass Mutual has, I think, a 25 basis point, which is about $100 million allocation. There are definitely others besides being on the balance sheet of Tesla, of Square, of MicroStrategy, and a whole bunch of other companies. I think if we were to have this conversation a year from now and more institutions come on board, and I think the important part for a gigantic investor like yours is you probably do want to see that market cap approach what, like Bitcoin is what, about 1.1 trillion, gold is maybe 10 or 12 trillion. I personally think in time Bitcoin will surpass gold, but that's not going to happen, I don't think, in the next year. So is it a market cap issue? Is that part of it?
Well, I don't think the market cap at 1 trillion is a limiting factor, but I think that maybe the liquidity within it is. I think I've seen some data on the concentration of ownership of Bitcoin is fairly pronounced, but in the size that we operate, so 1% of our funds, $600 million. My impression is that over some reasonable period of time, you could build a position in Bitcoin at that size. So I don't think that's the limiting factor. The limiting factor, to a degree, is its adoption among institutions, and that's moving at a pretty solid pace, I would say.
Pretty solid, yes.
Yeah, I mean it's difficult to, as a state fund, to do something that is not common among your peers. So as much as I like being a contrarian, another year of adoption at the same pace that we had in the last year, I think would go a long way with pension funds and other allocators. But there's certainly allocation occurring right now. You mentioned Mass Mutual, but some of the university endowments, I think, were faster than the state pension funds on the institutional side. And our custodians, Bank of New York Mellon, they now have rolled out like a crypto custody platform, I believe, in the last 3 or 4 months. So that maybe it wouldn't have, previously we might have had to work with a vendor like Coinbase or something. We now would be able to do it with our primary custodian.
Yeah, I mean, the over-the-counter services of organizations like a Coinbase, a NYDIG, a Fidelity, and now organizations you're going to see, I'm sure, by the end of this year, Goldman, JP Morgan, they already have digital asset divisions, but you're going to start to see them be more active in ways that you could institutionally own, custody, cold storage, deeply secured keys. But yeah, the trend is not going to just go from digital back to analog. I mean, it's going to have its times of volatility. I get it. But I think it's inevitable from even the largest of allocators like yours. Well, if you answered it that way, as maybe indirectly, but the short answer is no, the next one's pretty obvious, but I'm still going to ask it anyway. Are you looking at or investing in Ethereum, Ether?
Yeah, the answer is no on that too. It's probably like, Bitcoin and Ether are probably like gold and silver. I like precious metals generally, and we went with gold because it's the kind of the blue chip among the precious metals. And I think Bitcoin probably has a similar role within cryptos.
Yeah, I mean, I would look at it a little more as maybe Bitcoin is a store of value, I guess you could say, like gold. But
right.
Very different in terms of Ether/Ethereum. Almost, if I had to compare it to a commodity, how about oil? How about the railroads that the rail cars will go on, and relative to the blockchain and what's being built, which relates to my next question. And I know it's more of a deep digital asset question, but it does tie into the Ether and Ethereum, and that is, will decentralized finance, aka DeFi, disrupt centralized CeFi, centralized finance? Do you have a specific opinion?
And what applications is that in other than crypto? It's not like the plumbing of the financial system is something that's been a topic, right? Like the
Right.
2-day settlement of stocks being highlighted by Robinhood, and I think some of those are issues with the design of the system being not decentralized. So, but I mean, I have to some extent kind of plead the fifth on that of like there are reasons why our financial system is designed the way it is, from regulatory to historical practice and things like that. And I think that in certain areas you'll see a move towards more decentralized systems, but I'm probably the wrong person to identify
I mean, you
what
probably
areas that would be.
some level of exposure to that through some of the venture capital, especially if you're in Pantera or one of those organizations that are, active in the space. I mean, you guys are so big with maybe even dozens of VC. You definitely have some exposure.
That's a good guess, I would say. Yeah.
And I mean, my audience knows my opinion. DeFi will completely disrupt CeFi. It'll happen within a couple of years. And if you're not ready and prepared, you are really going to miss out. And it's really going to get interesting. Why don't I put it that way from my perspective? A little bit more classic and traditional. Will 10-year treasuries be a prognosticator, Marcus, end 2021 closer to 3% or 1%?
That's a good question. I think that the Fed is going to feel the pressure to maintain longer term interest rates lower. I think if the Fed allows its balance sheet to shrink and let the market kind of price out the yield curve, I think you'd be closer to 3%. I'm skeptical. I think that Powell is going to be quite reluctant to do that, and that will put a lid on where 10-year yields may go in the next 12 months. But it's kind of like it's in that same bucket of inflation, of just one of the biggest questions in the markets, and where central bank balance sheets have gone in the last year is unprecedented. And we know the last time that Powell tried to start tapering in late 2018, how badly that went and how, aversely the markets reacted. So, the next big test, I think, will be if the 10-year starts going higher and starts, being perceived as a dampener on economic growth, whether the Fed will start tapering again. I'm skeptical they're going to be able to.
What's an inflation hedge? In the US, we really, as much as I said, which I definitely believe is true for the super rich, big spenders and all that, and looking to buy more assets, true inflation is much, much higher. But very broadly, I guess we've never really had hyper inflation. If something were to go to hell in a handbasket from that perspective, what do you think would be a good hedge?
Well, I mean, I think that we've grown accustomed to the U.S. being the dominant country and the dominant equity market in the world in the last 100 years. And so, I mean, I think first people and investors should have diversified portfolios. So lots of international stocks, and so I don't think there's a silver bullet for inflation. I think the hyperinflation environment you're describing could go in a lot of different ways. So I like gold, I like commodities, I like real estate, and I like international stocks. And those items should be owned in some material way in everyone's portfolio for that very outcome. And you could add Bitcoin to the list. I'm leaving it off for now because I haven't fully studied it yet, but I think it's emerging and getting more and more adoption is something that some people are adding to that list.
Don't worry, Marcus. I'm going to save this one for James Alt to share, but I'm seeing it on my list. I'm chuckling. Are we living in a simulation? And why not? Don't worry. I don't want to get you in trouble.
I'm staying away from that one.
Here's an interesting one. It partly pokes at value investing, but it just it's interesting. Is the stock market a beauty contest? Don't think so? Well, do you understand game theory, behavioral finance, the crowd? And that applies potentially to Bitcoin and other things that we spoke about, but that's not to be dismissed. That's real. I mean, game theory and all that. So to me, I've always said, I mean it just a little tongue in cheek. Yeah, the stock market is a beauty contest.
I mean, I think in the short term it is, but this, the cycles will play out, and I think we're in a bit of a euphoric cycle right now. So when you're in a euphoric part of the cycle, I think, for short-term performance, it can, figuring out what the crowd is going to like in a week or two is, a pretty effective strategy. I think I'm an advocate of value investing. I don't like to describe value investing as dividing the market into halves and one half is value. But that's how it's defined, by Russell indices and others. I think that not I think buying high quality businesses that trade at reasonable multiples is a formula for long-term success, but that's very different than buying the half of the market that is the lowest price book multiple.
Good points. Good points. Well, Marcus, this has been great. I always enjoy talking with you and having you on. You don't have anything to offer or sell. You're the CIO of the Alaska Permanent Fund. But if you wanted to give a little bit of a close and wanted to talk about anything else you do where people could learn more about you or maybe follow you, how could they do so, assuming you're interested?
No, I'm on Twitter. It's at Marcus Frampton. So I only recently kind of engaged on Twitter, like in the last year. So I'm still sub 1,000 followers. So I like to interact with as many people.
We will help to
on there.
double that for you, I hope.
But my Twitter following is a ground floor opportunity.
Well, that's great. I mean, I, again, really enjoy my conversations with you. It's great for the perspective of my audience. Everyone, I'm Angelo Robles, host of the Angelo Robles podcast and founder and CEO at Family Office Association, a global membership organization dedicated to families of success, great investors in their family offices. Go to our website and learn more, including membership, simply familyofficeassociation.com, and follow us on social media. Lately, I've been very, very active actually on Instagram with some unique proprietary content. It's the full company name, so it's a little long, at Family Office Association, and you'll see me. And YouTube, we've of course have been very, very active in. We're simply Family Office on that. So again, Marcus, thank you so much. Our live audience, those that listen or watch it, we hope you enjoyed it. It's always great to have Marcus on. Marcus, I look forward to the next time. Thank you.
All right. Thank you.